Welcome to ValueBot Studios, where AI-powered insights meet real-world investing. We decode earnings, valuations, and growth fast. No fluff, just what matters. Whether you're short on time or deep in the game, this is your edge. Tap subscribe and let's get into it.
Okay, so Amazon's Q2 2025 earnings report. Did you catch that one?
Oh, yeah. Definitely a bit of a head scratcher, wasn't it?
Right. I mean, they announced record operating income, really strong revenue growth.
Even beat the EPS estimates the profit per share analysts were expecting.
Exactly. Delivered more profit than predicted. And yet, the stock drops, what, 8%?
Yeah, a pretty steep drop. So what on earth happened there?
Well, that's what we're here to figure out. Welcome to the deep dive.
Where we take a whole stack of info, articles, reports, notes, and try to pull out the key nuggets for you.
And today, we're diving deep into Amazon's second quarter results. We've got the earnings call transcript, a detailed Morningstar analyst report.
And our mission really is to unpack this paradox. What does it all mean for Amazon, its different businesses, its big picture strategy?
Because this isn't just about the numbers for one quarter, is it?
Not at all. It's really about investor feelings, I suppose, the sentiment, and the quality of that growth. Plus, Amazon's always making these huge long-term bets.
So we're going to explore why a company can look fantastic on paper.
Right, really knock it out of the park with the headline figures.
But still face a skeptical market. Investors are definitely looking past the immediate news here.
Okay, so let's unpack it. The Q2 results, on the surface, looked undeniably strong.
Yeah, revenue was $167.7 billion. That's up 12% year over year if you adjust for currency fluctuations. Pretty healthy.
And operating income, that's the profit from the core business before interest and taxes.
Right. That jumped to $19.2 billion. A huge 31% increase from Q2 last year.
Net income up 35% too, to $18.2 billion. That works out to $1.68 per share.
So generally beating their own forecasts and what analysts expected.
But then that market reaction, that 8% dip, it's fascinating, isn't it?
It really is. It tells you investors were, reading between the lines.
I think so. Morningstar's analysts actually called the drop an overreaction. They thought the shares looked attractive even after the dip.
Okay, so they see value there.
They do, but, and this is important, the report also hinted at the reasons for concern, things that might be tempering enthusiasm.
Like what specifically?
Well, AWS margins, for one. They were down quite a bit from the record high they hit in the first quarter.
Oh, okay.
And then there are the upcoming costs for Project Kuiper, their satellite internet projects. Launching satellites isn't cheap.
Right, that's going to pressure margins, at least in the short term.
Exactly. So you see this disconnect, reported success versus this forward-looking market view that's maybe a bit worried about future profits and the cost of these big investments.
Okay, so if the big numbers were good, where did the market find these worries? Let's break down some of the key metrics from the quarter. Maybe the clues are there.
Good idea.
First off, that operating income jump. It nearly doubled globally year over year.
Yeah, pretty staggering.
North America was up 48% to $7.5 billion. And international, wow, up 448% to $1.5 billion.
That international performance has been improving steadily over the last 10 quarters, hasn't it?
It has. Nearly a 700 basis point increase in operating margin there. That's a 7% jump in profitability. Huge.
It is impressive growth, but connecting it back to the bigger picture, the market looks hard at the quality of earnings, not just the amount.
What do you mean by quality here?
Well, take AWS, Amazon's big profit engine. Its operating margin fell from that record 39.5% in Q1 down to 32.9% in Q2. That's a noticeable drop.
Okay, and you mentioned reasons for that.
Yeah, part of it was seasonal things like more stock-based compensation hitting the books in Q2, and also higher depreciation because they're spending so much on new data centers and equipment. That's the CapEx, the capital expenditure.
Gotcha. So those things signal maybe margins could be under pressure going forward.
Exactly. And investors pick up on that because it affects future cash flow potential.
Okay, so profitability picture is a bit mixed. What about sales drivers? What's bringing the money in?
Well, AWS revenue growth did speed up a little bit. It grew 17.5% year over year, reaching $30.9 billion.
And Prime Day, always a big one.
biggest ever, apparently. Customers saved billions, sellers hit records, standard Prime Day stuff, but bigger.
And advertising, that seems to be a growing story.
Oh, absolutely. It was a powerhouse. $15.7 billion in revenue, up 22% year over year. That's a really significant chunk now.
Yeah, that ad growth is key, isn't it? Morningstar highlighted that too.
They did, called it impressive, said it helped buoy overall results. And the expectation is that advertising will keep growing faster than e-commerce.
And be highly profitable. Margins over 30% maybe.
That's the thinking, yeah. But going back to AWS for a second, that 17.5% growth, while a slight reacceleration, still needs context.
You mean compared to competitors? Like Microsoft's Azure?
Exactly. Azure has been showing faster growth rates. Now, Amazon's AWS base is way bigger, so percentage growth is harder. But the market sees that comparison.
And worries maybe AWS growth is hitting a plateau, or gets concerned about the sheer amount they're spending on AI infrastructure.
I think that's right. The market is always looking ahead. So concerns about growth ceilings or this massive CapEx ramp up for AI, it might have just put a damper on the enthusiasm, even with the good headline numbers.
It really feels like the market is trading that current profit strength for future uncertainty, doesn't it? Even if that uncertainty holds massive potential.
That's a good way to put it. Which leads us right into the future, right? Amazon's huge bets on AWS and AI, they're really in the spotlight now.
Yeah, Andy Jassy, the CEO, seems completely convinced. He said AI will change every customer experience.
He's betting big on it, improving everything: customer experience, innovation speed, efficiency, growth.
And AWS is still the engine funding a lot of this, right?
Yeah.
$10.2 billion in operating income just in Q2.
Absolutely. And they are pouring money into generative AI services and their own custom chips.
Like Trainium 2.
Yeah, their AI training chip. They called it the backbone for Anthropic's models.
Yeah.
And their Bedrock service.
That's the one letting businesses build AI apps using different models.
Right. They claim their chips give 40% better price performance for inference that's running the AI models compared to other GPUs.
And they launched their own big model, Amazon Nova.
They did. Already the second most popular on Bedrock, apparently, with unique customization options for businesses.
So this brings up the big question, the one clearly nagging investors. All this spending, this huge CapEx, will it pay off? Or is it just a massive cost sink?
It's the question. They reported $31.4 billion in CapEx in Q2 alone. That's eye-watering.
Wow.
And most of it driven by AWS needing more capacity for AI, for those custom chips, for all the tech infrastructure. Jassy basically said, we're going to keep spending heavily here because the AI opportunity is just too big to miss.
It's like they're building the whole AI stack themselves. Chips, models, tools.
It is incredibly ambitious, like a chef deciding to build the farm and the mill and the ovens, not just buy ingredients. Hugely ambitious, hugely expensive.
And they're building tools on top too, like Strands and Agent Core.
Yeah, tools for building and deploying AI agents for businesses. And coding assistants like Kuro, apparently 100,000 developers wanted access in the first 5 days. So pushing innovation at every level.
Okay, but how does this stack up against the competition? Microsoft's Azure, Google's Cloud, and their TPUs.
Well, Jassy admitted AWS has more demand than capacity right now. Power is the biggest bottleneck, he said.
More demand than capacity sounds like a good problem.
It can be, but it also fuels concerns. While AWS has strengths in operations, security, features, some analysts worry they might be falling behind in generative AI specifically because competitors are showing faster cloud growth overall.
Okay.
But there's a counter-argument for Morningstar. They pointed to new, much cheaper AI models like DeepSeek's R1. If the core AI model tech itself becomes cheaper, more like a commodity,
Then maybe the demand for the underlying cloud infrastructure, the computing power, the storage that AWS provides actually goes up.
Exactly. It could benefit Amazon in the long run, even with the heavy spending now. So yeah, they're spending like a leader, but the payoff timeline, the competition, it's all making the market a bit nervous about the immediate costs.
Makes sense. So beyond the intense focus on AWS and AI, Amazon is obviously much more than that. It's this huge, diversified empire.
Right. And Morningstar talks about its moats, those competitive advantages, and its optionality, meaning future growth avenues.
Let's talk about advertising first. You mentioned it earlier. It's becoming a real powerhouse, almost quietly.
It really is. $15.7 billion in Q2, growing 22% year over year. Morningstar thinks it could become a $50 billion plus business.
Wow. with high margins too.
Very likely. Probably over 30% operating margin. It's driven by all that unique data Amazon has on shoppers. Marketers love it because they can reach people right when they're looking to buy.
So that data is like an intangible asset moat.
Exactly. That data, plus the network effect buyers and sellers meeting on Amazon, creates a really strong, high-margin growth driver, and it pulls people deeper into the Amazon ecosystem.
Which brings us to the Prime ecosystem itself. Morningstar called that a powerful, virtuous circle.
Yeah, you pay your $139 a year, you get the free shipping, the video, the music.
And it's all designed to make you stick around and spend more, right?
Totally. It creates switching costs. Once you're used to Prime, it's kind of inconvenient to leave.
And that reinforces their main retail advantage, the wide moat, based on cost, selection, convenience.
Right. And things like Kindle, Echo, the video content, they just deepen that engagement, keep you locked into Amazon's world.
We got one more piece. Project Kuiper, the satellite internet project. That feels like a real moonshot.
It definitely is. Low Earth orbit satellites, they've had their third successful launch.
And they're planning a beta service late 2025 or early next year.
That's the plan. Jassy pointed out there are, 500 million households globally without good broadband. Huge potential market.
They think Kuiper can offer better performance at a compelling price.
That's the pitch. And apparently, they've already signed deals with businesses and governments even before the commercial launch, which is pretty impressive.
But as Morningstar noted, those launch costs are going to hurt margins for a couple of quarters.
For sure. And this raises that optionality versus focus question again. Is Amazon spreading itself too thin? Getting distracted?
Or is it all part of a grand strategy where everything reinforces everything else?
That's certainly the company line. They believe it all adds up to a better customer experience and justifies the investment by delivering returns way above their cost of capital in the long run.
Okay, so we've got strong performance, massive investments, competitive heat, these different business modes. How does this all translate into the valuation? What's the market sentiment telling us now?
Well, according to Morningstar's latest look, they put Amazon's fair value at $245 per share.
And the stock's trading around $234.
Yeah, so their price to fair value ratio is 0.96. They classify it as fairly valued. Even after the dip, analysts don't see it as wildly overpriced based on fundamentals.
But there's always a but, isn't there?
Usually. In this case, it's free cash flow, or FCF. That's the cash left over after all the operating expenses and the CapEx.
And investors watch that closely.
Very closely. Morningstar's forecast actually shows FCF decreasing significantly in 2025, down to about $46 billion from over $92 billion in 2024.
Ouch. Why such a big drop?
It really backs up the argument from the bears, the pessimists. They argue that all this heavy spending on fulfillment centers, delivery networks, and especially AWS and AI is going to really dampen that free cash flow growth, at least for a while.
So the market skepticism seems focused squarely on the immediate returns from these huge AI and infrastructure bets.
Yeah, that seems to be the crux of it.
It's fascinating given Amazon's history with AWS, right? That started as a massive investment that nobody quite understood.
And it turned into a profit machine.
Exactly. So what makes the market so nervous this time with the AI spending? Is it just the sheer scale of it? Or something different about the competition?
It's probably a mix of both. The scale of investment is truly enormous, maybe unprecedented even for Amazon. And the AI field is incredibly competitive and fast-moving. Plus, this leads to those critical forward-looking questions.
Like, will this current CapEx spree, especially for AI, actually generate the kind of returns AWS eventually did?
That's the multi-billion-dollar question. Jassy is obviously optimistic. He keeps pointing out that most IT spending, like 85–90%, is still happening on premises, not in the cloud.
So there's still a huge market to capture.
A colossal market. And he believes AI will actually accelerate the shift to the cloud over the next 10–15 years.
So is the current mood just short-term fatigue from investors seeing yet another massive investment cycle? Or is it pricing in genuine long-term risk?
It's hard to say definitively, and you've got rising regulatory concerns for big tech swirling around too, adding another layer of uncertainty.
But Amazon's core strategy hasn't changed.
Doesn't seem so. Management keeps repeating the mantra. Focus on the customer broad selection, low prices, amazing convenience. They believe that's the only reliable path to creating long-term shareholder value.
Okay, so let's try and wrap this up. Where does this leave us?
Well, Amazon delivered a strong quarter by many measures. Revenue, operating income, advertising growth were all pretty impressive.
Yet the market yawned, or worse, sent the stock down. It really boils down to a fundamental question, doesn't it?
I think so. Is this stock dip just the market being too focused on short-term costs and temporarily mispricing the stock?
Or is it sending a strategic message? Maybe telling Amazon, we're getting nervous about this level of spending without clearer, faster returns.
Yeah. This quarter really makes you wonder, is Amazon still that relentless compounding machine it used to be? Or is it just getting so big, so diverse, that super fast growth is just harder to sustain?
For investors, maybe underestimating the optionality, the future potential from ads, Prime, Kuiper.
Or is the market finally starting to, discipline Amazon's ambitious sprawl, pushing for more focus, especially with the huge sums going into the competitive AI race?
It's a tough balance.
Okay.
So here's a final thought for you to chew on. You've got a company with Amazon's incredible track record, still investing heavily in the future, robotics, AI chips, satellites, you name it.
Right. They're playing the long game, as always.
So does the market's immediate negative reaction signal a real shift in how investors value long-term vision versus short-term profit today? Or is it just a temporary pause, maybe a bit of indigestion from all the spending before that next wave of innovation eventually pays off?
That's it from ValueBot Studios. Smart investing, simplified by AI. If this helped, follow, rate, and share with a fellow investor. The market moves fast. So do we. Subscribe now and stay ahead. Until next time, goodbye.